How much are dividends costing your retirement? Now, this is a puzzling question for a lot of retirees because dividends are generally thought of as a very good thing. And they can be depending on what type of account you hold those dividends in. Now, after all, a dividend is essentially profits that a company has generated that they are now passing to shareholders, passing to you, a retiree. And so isn't that a good thing? Profits are a good thing. And yes, they can be if you're holding those dividend generating investments within a tax protected account. But when you're holding those dividend generating investments within a taxable account, these dividends can cost your retirement significantly due to an expensive cost called dividend tax drag. Now, this dividend tax drag concept can cost your retirement tens of thousands of dollars, and we're going to show exactly how within this presentation. So make sure you watch this presentation until the end to be able to see all of the details that you need to be thinking about with dividend tax drag. Now, if you end up liking this video, please hit the like button down below, hit the subscribe button. These are the best 2 actions that you can take to help other retirees just like yourself find this video and hopefully gain some value from this video. So let's get into it. Now, we've previously recorded numerous videos around how to make your retirement more tax efficient, specifically with tax efficient investing. We previously held a Wealth Wednesday where we talked about 5 simple taxable account rules you should use for tax efficient investing. Now, I'm not going to go over all 5 taxable account rules within this presentation here today. I want to focus on rule number 3. Don't hold high dividend investments. And we've gotten a few questions from why wouldn't you want to hold high dividend investments within your taxable account? And so this video today will hopefully show exactly why you don't want to be holding high dividend stocks within your taxable account. Now, I'll link to this 5 taxable account rule video up in the right hand corner for those that want to watch this video after this video is done. But there's an important concept that we've discussed in a few other videos called tax equivalency. And this idea of tax equivalency will help you wade through how to weigh taxes today versus taxes in the future and how everything shakes out on that front. Now, previously when we've talked about tax equivalency, we've talked about tax equivalency in terms of Roth conversions. So should you make a Roth conversion today versus taking that money out of your tax deferred account at some point in the future? And previously we've talked about that if you're paying the same exact rate, let's say 22%, those are tax equivalent scenarios. So for instance, let's say that we're looking at contribution and withdrawals. Okay, that during the growth phase is tax protected, whether it's in a Roth IRA or whether it's in a tax deferred account. Now, tax equivalency, when we're talking about Roth conversions, is pretty simple, pretty straightforward. Let's say that you keep money in a tax deferred account. You don't make a Roth conversion, but then when you make a withdrawal from that tax deferred account, you're paying, let's say, 22%. Okay, that is the same exact scenario as if you made a Roth conversion and paid 22% and then withdrew that money tax-free. You will have the same exact after-tax wealth at the end of that. That's this whole idea of tax equivalency. Now, where this idea of tax equivalency breaks down is during this growth phase right here. Now, again, with a Roth IRA and a tax deferred account, you have tax protection during this growth phase, either with tax deferral or tax-free growth. But in a taxable account, anytime you make a change, anytime there is a distribution coming from that taxable account, it can translate to a taxable event. And this is where dividend tax drag really shows its ugly face. When we're paying taxes on an ongoing basis because of something dragging down our performance, all of a sudden now we have some non-efficient tax investing. And so let's first talk about why there is a dividend tax drag. Well, how does a dividend work and what are the tax consequences of a dividend? Well, let's say that you have an investment, you own shares in a company, and that company pays out 2% per year in dividend income. Now, that is a taxable event. That dividend that is passed to you is a taxable event, regardless of what you do with that dividend. Now, if you take that dividend as income, going back to that tax equivalency idea, that is completely fine. We have now taken that dividend on the withdrawal side of things. And so now if we're taking that as income, we don't see this effect of this dividend tax drag. But if we're reinvesting that dividend, essentially what we did is we just took a distribution from our taxable account, we paid out taxes, and now we have less money that's compounding for us for the future. And so when we're reinvesting that dividend for future growth, this is when we start to see dividend tax drag. And so let's show exactly what the cost of dividend tax drag is. On the screen right now, I have the growth of a $100,000 portfolio growing at 10% per year for 20 years at various dividend rates. Okay, and as we see here, if we have an investment that has no dividend we see this investment grow from $100,000 to over $670,000. On the right-hand y-axis, we have the percent difference between these various rates. And so in the most extreme example here of an investment that pays out a 5% dividend, you notice that this investment only grows to less than $590,000. This dividend tax drag costs you over 12%. Now it's important to note here that we're looking at this in terms of something called step up in basis. So what happens with a dividend, when you take a dividend and you pay taxes on that dividend, what happens is your cost basis now rises because essentially you just paid taxes on a dividend and now your cost basis is updated to reflect the taxes that you just paid on that given dividend. And so in these examples, what you will see is that a no dividend investment has a lot larger unrealized gain than a 5% dividend investment does because you're paying taxes on an ongoing basis and thus raising that cost basis. And so we're looking at this in the context of something called step up in basis. And this is really a hidden power of a taxable account. As you're investing in your taxable account, there's a percentage of that taxable account that will be the cost basis. That is money that you've already paid taxes on, that when you withdraw that money, you will not have to pay taxes again. But then there's a portion of that account that is unrealized gain. Now, when you withdraw the unrealized gain, you will have tax consequences. If that unrealized gain has happened in an investment that you've held for over a year, you have long-term capital gains. If it's within an investment that you've held for less than a year, it's short-term capital gains, otherwise taxed at ordinary income rates. Now, the hidden power of a taxable account is using it as an estate planning tool. Right now, there's something called step up in basis. Now, this has previously been talked about that Congress is potentially fading out going forward in the future, but right now we have a step up in basis rule, meaning that when you pass away and you pass that taxable account on to the next generation will receive a step up in basis, meaning that unrealized gain is essentially eliminated. And the new basis is the market value at the time of death. And so this is extremely powerful. And when we look at this in terms of step up in basis, meaning that this is a taxable account that this person is investing for the next generation. And so when they pass on to the next generation, that unrealized gain will be wiped out. And so we see a very wide gap in terms of what a no dividend stock can do for you versus what a 5% dividend stock will cost you in terms of growing at the same exact growth rates here. And so what happens if we look at this through a context of not having a step up in basis? Again, Congress has talked about eliminating a step up in basis. What happens if they eliminate a step up in basis or this retiree decides to liquidate the unrealized growth that they have? And so they're going to pay that capital gains through that liquidation. Nonetheless, we see the exact same concept play out just at a varying degree. So once again, we see the no dividend investment, because it doesn't have a dividend tax drag on it, will result in the highest amount of after-tax wealth here. It will result in over $585,000 in that taxable account after liquidation. And at every varying dividend rate, we see this after-tax value fall. For instance, this 5% dividend will grow to less than an after-tax value of $550,000. Now, over on the right-hand y-axis, we see the percent differences are cut because we're fully liquidating this account. We're trying to turn it into an after-tax amount. But nonetheless, we still see over a 6% difference in value between the no dividend investment and a 5% dividend investment. Now, thus far, we've been looking at everything at paying a 15% long-term capital gains rate. But we know, based on how much income we show in any given year, we may be paying much higher than a 15% long-term capital gain rate. For instance, many retirees may not know that if they show for a single filer an AGI over $200,000 and for a married filer an AGI over $250,000, they will owe a net investment income tax. This is an extra surtax of 3.8% that's applied to your long-term capital gain rate. Now, it's important to also know that this net investment income tax is not adjusted to inflation. So that $200,000 and $250,000 threshold will not adjust going forward into time. But what we see when we translate this in terms of a dividend tax drag, the higher long-term capital gains rate that you pay, the more costly a dividend tax drag will be. This makes sense. A taxable event that you're paying out more in taxes to means that less is compounding for your future. And so in this scenario, we see a no dividend investment grows to over $560,000. Again, we're looking at after-tax liquidation value. And a 5% dividend investment grows to less than $520,000. An over 8% difference in total value here. And once again, when we bump this up to the next zone, so rather than paying a 15% long-term capital gains rate, we're looking at paying a 20% long-term capital gains rate. But again, we have to add in that net investment income tax. We see this dividend tax drag cost rise even larger. So again, with a no dividend investment, we see it rise to over $530,000 in after-tax liquidation value. In a 5% dividend investment, we see less than $490,000. And so this is basically a 10% difference in total value. The message that we see here, the higher long-term capital gains rate or the higher tax rate in general that you're paying, the more costly dividend tax drag will be to your retirement. Well, the opposite is also true. If you were in the 0% long-term capital gains zone, essentially there is no dividend tax drag for your situation. In fact, you would just receive a larger step up in cost basis because that dividend that you are receiving is tax-free. And so there is no dividend tax drag if you're in that 0% zone. But be careful because there are often times where you can drift out of that 0% zone. So if you think you're going to be in that 0% zone for your entire retirement, then yes, there may not be a dividend tax cost. But if you're floating through these different tax rates, be careful. Now, what are the tax consequences of a dividend? Well, they, one, have varied through time. And number two, it depends on what type of dividend you receive. So there is a non-qualified dividend and a qualified dividend. A non-qualified dividend is taxed at ordinary income rates. A qualified dividend is taxed at long-term capital gain rates. And so again, there is a vast difference between long-term capital gain and short-term capital gain, ordinary income rates. And so what we see here, again, qualified dividends are taxed at 0%, 15%, technically 18.8%, or 23.8%. This 20% bracket is really a mirage right here because of that net investment income surtax. But nonetheless, we've also seen that dividends have varied their tax status through time. Right now, qualified dividends are taxed at long-term capital gains rate. But previously, they've been taxed at individual income rates. They've also previously been tax exempt. And so know that this is a floating and changing dynamic within tax laws. As we move forward into the future, there's already been some discussion around changing long-term capital gain rates for those that earn a certain level of income, actually changing it back to ordinary income rates. So we may see another couple zones here of long-term capital gains tax rates moving forward into the future. So know that this is a changing dynamic through time, and obviously this will change the total cost of dividend tax drag for your situation. Then the question arises, how can we avoid this dividend tax cost to our retirement? How can we avoid it costing us tens of thousands of dollars throughout our retirement? Well, by plugging the leaky bucket of our taxable account. Again, we've discussed this in previous videos. We've discussed this in that Wealth Wednesday where we talked about 5 taxable account rules for tax efficient investing. But really our goal here is to try to make sure that we have as little tax drag leaving our retirement as possible, leaving that taxable account. And so how you can set your retirement up for better tax efficient investing is hold your high dividend stocks within your tax protected accounts. If you hold your high dividend stock within an IRA, there is no tax drag associated with dividends, just when you hold it within your taxable account, your brokerage account, your joint account. And so within your taxable account, instead you want to hold either no dividend or very low dividend investments. Now, oftentimes I hear from retirees, isn't a dividend company earning a profit and paying it to shareholders? So if we're holding companies that have either a low dividend or no dividend, doesn't that mean that there is little to no profit for that company? Why would I want to hold those type of investments? Now on the screen right now, I have a list of companies that in fact do not pay a dividend. From a company management standpoint, there are a lot of things that you can do with profits. You can pay those profits out to shareholders in terms of a dividend. You can also buy back some of your stock. You can hire more employees. You can invest those profits inside of RMD, thus trying to increase the value of your company going forward into the future. And so a company can still make a profit and not pay out a dividend. In fact, on the screen right now, we see 20 companies filtered by the largest market caps. And we see that there are a lot of very strong companies that don't pay a dividend. For instance, Google, Alphabet, Amazon, Tesla, Facebook, otherwise known as Meta, Berkshire Hathaway, Walt Disney, Netflix, Adobe, PayPal. There are some massive companies out there that many times can be good investments for your future that don't pay a dividend. And so this idea that good companies pay a dividend and bad companies don't pay a dividend really is a very large myth that we need to do away with. Within your taxable account, you may not be able to achieve a no dividend investment, but we should certainly be striving for a low to minimal dividend investment to try to avoid this dividend tax cost to our retirement. And so it's also important to note that although we're focusing on dividends within this presentation right now, it's not just about dividends. It's about any event within your taxable account where you have to, during this growth phase, take a taxable event, pay out taxes, and so thus you have less money compounding for your future. Whether it's dividends or whether it's turnover within your account, whether it's a capital gain that's forced upon you by a mutual fund, any type of taxable event within your taxable account during this growth phase, if you're paying out taxes, is going to weigh down your performance. There's going to be a drag in after-tax value at the end of your retirement. And so if your goal is to end up with the largest after-tax wealth throughout your retirement, you want to make sure during this growth phase, specifically in your taxable account, brokerage account, joint account, individual account, we are controlling dividends. We are trying to search for low dividend investments or no dividend investments to try to decrease and eliminate this dividend tax cost to your retirement. Because as we can see through these various examples, it can cost your retirement tens of thousands of dollars. Now, hopefully this video was informational. Hopefully it showed a lesser discussed topic around how you can make your taxable account that much more tax efficient. Now, if you found value out of this video, please do us a favor, hit the like button down below, hit the subscribe button. We release videos like this on a weekly basis for how you can improve your retirement. We appreciate you spending time to watch this video and improve your retirement. We hope to see you in the next video. Thanks.